In this video, I'm going to look at transactions and how they affect the accounting equation. So transactions and how they affect the accounting equations. We're going to record transactions in a table, and at the end I'll just do a quick calculation on profit and owner's wealth, and while I do this I'll apply the accounting rules which I covered in the previous video. There you can see I'm going to include a tiny little story as I go along. That's a chameleon. The chameleon lives in my front yard at home, and you can see here that's a bird. It's called a dikkop, and that's a bigger picture of the dikkop. And the chameleon and the dikkop are always fighting. There's always conflict in the front yard. Then I'll bring this into the little story. A cow came and sat on my front lawn, and if you look very carefully, a swarm of bees also decided to come and settle in the front lawn. But obviously the main focus will be the accounting, but I thought I'd add just a little story to go with it. This is just an enlargement. There's our chameleon character and the dikkop, which actually means in English thick head. The name of the bird is a dikkop. I'm going to look at these transactions of Calibu Education for the month of January 2024. There was a capital contribution, a purchase of stock, purchase of a computer, credit sales, paid for insurance. There was a withdrawal of petty cash, and we paid the computer store for the computer, and we received a bank statement, and we needed to record bank charges. So these are the 8 transactions I'm going to have a look at, and I'm going to have a look at these transactions and how they affect the accounting equation. I will follow the steps on how to record a transaction, and I'll go through each one individually as I tell you a little story about the bees, the cow, the chameleon, and the dikkop on the side. Every single transaction is documented. Here, in order to record the first transaction, where myself, Richard the owner, made a capital contribution of 250,000, and this was made in favor of Richard's business, Calibu Education Accounting Lessons. This receipt was issued to me, the owner, actually by my wife, Marushka. There she's my bookkeeper, and she has signed the document. So a receipt is a proof of payment saying that I made this capital contribution to Calibu Education to fund this business. Now this document is used to record this transaction that has taken place. A receipt is a proof of payment, and by the way, this receipt would be a duplicate copy, as the original copy was issued to myself, Richard, and the bookkeeper has kept a copy, the duplicate of the original. Now this document here is going to be used to record this capital contribution. In the previous slide, we saw the receipt that was issued. Now the receipt is being used to record the transaction. The transaction, Richard, the owner, made a capital contribution of 250,000. Let's make it euros today because I'm busy watching the World Cup rugby and it's in France. So 250,000 euros, that's the capital contribution. And I have the following table which the examiner can use to record transactions. It's a good way to test you for the examiner without drawing up journals. So you can get lots of different transactions and they ask you to complete the transaction in a table with the following headings. I've included lots of headings in this table. Sometimes they might just say account debit, account credit, and what is the effect on the AOL, the accounting equation. But I've added columns for reason, I've added subsidiary journal, document. So it's quite comprehensive, this table. It should cover everything that you can be asked in a table when you need to record a transaction and show the effect of the transaction on the accounting equation. So that DOC stands for document. I've just given these transactions numbers. It's transaction number 1. The document to record this capital contribution as it was a cash contribution. So the cash was given to the bookkeeper and the bookkeeper issued a receipt. That's how it was documented. Receipt 001. And as I mentioned in the previous slide, the bookkeeper would have the duplicate. This is recorded in a journal, a subsidiary journal, and it is the cash book receipts. The account that is debited in the GL, which stands for General Ledger, is bank. Now I'm dealing with these steps here that I have dealt with in previous videos, but it's the steps to deal with the transaction. Read the transaction. Richard made a capital contribution of 250,000. Issued receipt 001. Identify the accounts involved. The one account is bank. The other account is capital. Now, if you remember, you need to classify the accounts. So what is bank? If it has a positive bank balance, it's an asset. Capital is its own category. It's a C. Then I need to apply the rules to decide whether the account is debited or credited. Now bank, we know is an asset. It fits the definition of an asset, a current asset. Now if the value of the asset increases, if the transaction results in the value of an asset increasing, it is debited. I'm applying my rules. And now under reason, I'm saying the account that is debited is bank. Why? There's an increase in the value of the asset. The books of the business, the bank account in the books of the business, I identified that as an asset. What has just happened to the business bank account? It's gone up by 250,000. The account that is debited is bank because we applied the rule. An increase in assets, there's a plus. You need to go check out the video of mine of accounting rules. An increase in assets, the general ledger account bank gets debited. And the reason there I've written just what I said, increase in the value of assets. That is why bank is debited. The account that is credited is capital. And if I apply the rule, there you can see it. There's a plus on the credit side of capital. An increase in capital, the account must get credited. Remember, we're looking at all these transactions always from the business point of view. So from the point of view of Calibre Education, why was capital credited? Because the rule says if there's an increase in value of capital, the account gets credited. Look there. I'll rub this out quickly. There's a plus on the credit side. That is the rule. Increase in the value of capital, the account in the general ledger gets credited. So account credit, capital. Reason? Increase in the value of capital according to that rule. Now the effect on the accounting equation. What happened to my bank balance? Let me rub this out quickly. Make it a bit cleaner, neater. What happened to my bank balance, which is an asset, the business bank balance? It increased by 250,000 plus 250,000. What happened to owner's equity? Under owner's equity, remember, if you've watched previous videos of mine, you get these 4 categories: drawings, income, capital, and expenses. That falls underneath owner's equity. So capital has increased by 250,000. That's why there's a plus there, plus 250,000. And liabilities, capital is not a liability, and bank is not a liability. So under liabilities, there's no effect. So ladies and gentlemen, the left-hand side of the equation, assets, is equal to the right-hand side, because you have 250,000. I'm just going to write 250 under assets, and you have 250,000 under owner's equity. 250 is equal to 250. Liabilities plus naught, because there was no effect. After every single transaction, the accounting equation will still balance. The left-hand side is equal to the right-hand side. As we go along, I'm going to do 8 transactions. You will get the hang of this. You know all the column headings of this table. We're going to complete all the headings. There will go, something will appear underneath each heading, and you will become masters of recording transactions in this table with those headings. So there's the first one. Okay, I've cleaned it up here for you. I read the transaction. I identified the accounts involved. I applied the rules. I filled in which document was used, which journal it was recorded. In the general ledger, the bank account was debited. In the general ledger, the capital account was credited. I provided reasons why the account was debited, why the account was credited, and then I recorded with numbers the effect on the accounting equation. And after this, the left-hand side equaled the right-hand side. So I'm going to record a whole lot of transactions, in this table. And like I said, you're going to become masters, and as we go along, I'll break it up with our little story of the chameleon and the dikop. A swarm of bees looking for a place to make a home, a hive, arrived in the garden, and they were really looking for a place where they could settle amongst the flowers. Okay, let's get on to number 2. Calibre Education made a cash purchase of stock, 7,300, paid by cheque 001. Most payments now are made by an electronic funds transfer, an EFT, but the textbooks are still talking about checks, so I'm going to work with this. So a cash purchase of stock for 7,300 was made by Calibre Education, and a check was written out. This here is the check. Now let's just run through this quickly. We have the date. This piece here on the left is called the check counterfoil. And what happens with the check is, oh, there's a mistake. It should say the stockists. That's from whom we purchased stock. Calibre Education has purchased stock from the stockist. So it's pay the stockists. The stockist is a shop or a supplier of, in this case here, Calibre Education is buying educational posters. The bank that Calibre Education banks with, it's just called the bank. Here we have a branch code or sort code of the bank. There it is as well at the bottom of the check. This piece of paper is issued to the stockists, and this part here remains behind, the check counterfoil. 7,300 euros was paid to the stockists by check. The bookkeeper in this case here has signing powers. The check was signed and only one signature was required. I trust my wife. She has signed this check. Quite often 2 signatures are needed. And it's the first check that Calibre Education has issued. Check number 1. So the stockists get this check, 7,300. Calibre Education has purchased stock. This check counterfoil remains in the checkbook, and it's going to be used to record the transaction in the table that we are recording the transaction. We've seen the check that recorded this transaction. Now we need to record this transaction in this table. The other steps for dealing with a transaction: read the transaction. So Calibre Education made a cash purchase of stock, 7,300, paid by check 001. Now, as we've seen, a check is a cash payment. The document that is used to record the transaction is a check counterfoil, where we record cash payments. The journal that we record cash payments is the cash book payments. Now, the account that is debited, we need to identify the accounts involved. Trading inventory or stock or merchandise, whatever you want to call it, was purchased, and a cheque was used to make the payment, so our bank balance will decrease when that cheque is deposited by the person who has received the cheque. We need to classify the accounts. Okay, we've identified them, trading inventory and bank. We need to classify the accounts. Trading inventory, by definition, is an asset, and bank is also an asset if the bank balance has a positive bank balance. We need to apply the rules to decide whether an account is debited or credited. So trading inventory is an asset. When we buy stock, there's an increase in the value of the asset stock. And the rule says if there's an increase in the value of an asset, the account in the general ledger must be debited. So in this column, we get trading inventory. And the reason, there was an increase in the value of the stock, of the asset. But on the other hand, bank, which is also an asset, when we made the payment by cheque, the bank balance decreased, and the rule says the account must be credited. So bank will appear in this column. Account credit in the general ledger is bank, and the reason, there was a decrease in the value of the asset. There was a decrease in the bank balance. Now we need to record the effect on the accounting equation, and this is an asset swap. We bought stock for cash. There's a plus 7,300 because the value of our stock increased, and also on assets there's minus 7,300 because there was a decrease in the value of the asset. There was no effect under owner's equity and no effect under liabilities. So yeah, we've recorded a transaction. Calibu Education purchased stock from the stockists. A cheque was issued, and we've completed this table. So transaction number 2 is now complete in this format. The green grass attracted the cows to the house. So now in the house, in the front yard, we had a swarm of bees who could produce honey, a herd of cows, cattle, that could produce milk, provide milk, and inside the front yard we had the chameleon and the dikkop who were still fighting. But business carried on as per usual. A computer was purchased on credit from the computer store, 12,000 euros. So let's have a look now how to record this computer. Oh, a computer was purchased on credit from the computer store, 12,000. This transaction needed to be documented. A computer was purchased on credit for 12,000. I'm going to ignore VAT for now. In this next chapter, I will do VAT. I will explain VAT. Your country might not apply VAT, then you can ignore it completely. But those countries that do have VAT, you can check out videos of mine on VAT. So a tax invoice was completed. One laptop was purchased by Calibu Education. The computer shop sold us the computer. There's the computer shop, and it was signed off when this laptop was delivered. It was purchased on credit, so their terms and conditions apply. This invoice needs to be paid within 90 days because Calibu Education has an account with the computer shop to buy computer items, printers, whatever you need, whatever Calibu Education needs, they purchase from their preferred supplier, the computer shop, and all transactions are documented. The original tax invoice is given to Calibu Education, and we, doing the books for Calibu Education, we use the document to record this credit purchase. We, as per usual, we follow the steps to record the transaction. Read the transaction. A computer was purchased on credit from the computer store, 12,000. We need to fill in the transaction according to this table. Identify the accounts involved. In this transaction, the accounts that were involved, we've decided to call the one account computers, as the account is big enough. It could have fallen under equipment. It depends how you decide to name your accounts. We're going to call this account for the computer, computers. This computer was bought on credit. The account that is credited, remember we're identifying the two accounts, is creditors control. Depending on your textbook, you might use accounts payable. Now I've got your creditors control, we're going to use that. And in brackets I've put here the individual creditor, the computer store. Who did we buy the computer from? The computer store. Let me explain this quickly. The account that is affected in the general ledger is creditors control or accounts payable. Depends what you want to use. The important thing is you categorize it correctly. Now we keep a separate ledger called the creditors ledger, which records in all the individual accounts of our creditors their details. That's why I've put in here. Let me clean this up a bit. Under account credit, I've put the name of the general ledger account and the name of the supplier, which goes into another ledger called the creditors ledger or accounts payable. I will discuss the creditors ledger in more detail in a different video. But the account in the general ledger that is credited is creditors control. Now we need to complete the rest of the table. The document we used to record this transaction, we received an original invoice from the supplier, the computer store. That is the document we used to record this transaction. We made a credit purchase, and the journal that is used is the creditors journal. That's the journal for credit purchases. We identified the two accounts involved: account debit, computers; account credit, creditors control. We need to classify these accounts. Computers, by definition, is an asset. It has value, right? It's an asset. There's an increase in the value of our computers on hand. an increase in the value of assets gets debited. That's why computers appears in this column, account debit in the general ledger, because there was an increase, a plus, in the value of the asset, computers. There we go. Reason, an increase in the value of the asset, computers. Why was creditors control credited? Because according to this rule, a creditor is a liability. We owe our creditor, the computer store, more. There's an increase in liabilities. The rule says credit that account. That is why it appears under account credit. And the reason, an increase in the value of the liability. We owe more. Now if we look at the AOL, the accounting equation, there's plus 12,000 under assets because the value of our computers increased. There's no effect under owner's equity. Remember what affects owner's equity? I like this acronym. DICE, drawings, income, capital, expense. None of those accounts were in this transaction. There's zero effect under owner's equity. And what happened under liabilities? There was an increase in how much we owed. We owed the computer shop another 12,000 Rand. And the left hand side is equal to the right hand side after this transaction. There we go. This here is practice. You take lots and lots of transactions and you record in this table the effect of the transaction. Which account is debited? Which account is credited? Which journal is used? What document was used? Why did you go and debit computers? Reason. Why did you go and credit creditors control? Reason. And what is the effect on the accounting equation? Practice. Practice. The chameleon and the duck in the front yard realized that the swarm of bees and the cows were looking for a place to live. And they knew that the bees would bring honey and the cows would bring milk. But the chameleon and the duck wanted all the honey and the milk for themselves. So they fought and they fought over what could potentially be good for them. But they wanted the honey and the milk to themselves. And business carried on in the backyard, in the office of Calibu Education. There were credit sales of the stock that was purchased for 2,500. The stock was purchased for 1,250. These posters, the stock, were sold to the school for 2,500. Originally, the posters cost 1,250, and it was a credit sale. So this credit sale needed to be documented. The document that was used by Calibu Education to record this sale to the school was a tax invoice. Now, the original was given to the school, and a copy was kept by Calibu Education to record this transaction. The school was also given time to pay, terms and conditions. Maybe they needed to collect the school fees before they could make the payment to us, Calibu Education. Remember, I'm not including VAT at this stage. The amount these posters of the accounting cycle were sold for was 10 Rand per unit. 250 posters were sold, so the invoice total was 2,500. Remember, the cost of these posters from the printers who printed these posters was 1,250, and they were sold in total for 2,500. This is the document used to record this transaction. Now we need to record this transaction. Credit sales of stock for 2,500, and we purchased that stock for 1,250. 1,250 was the cost price of the items being sold. This needs to be recorded. Steps to deal with any given transaction. Read the transaction. We've done that. Identify the accounts involved. Now this is a very important transaction. Let's just deal with the document. The document that was used to record this transaction in the hands of Calibu Education, we're doing the books for Calibu, was an invoice duplicate. We have made a credit sale. Credit sales are recorded in the debtor's journal. The account that is debited in the general ledger is an account called debtor's control. It's an account which is basically a summary of all the individual debtors. You might call it accounts receivable. I have put in brackets here the name of the individual debtor. These posters were sold to the school. Now, the account that is credited in the first part of this transaction is sales. And let's have a look now and apply the rules. Classify the accounts by definition. Okay, we classify these accounts. A debtor or accounts receivable is an asset. Sales is income that is being earned by the business. And if I apply the rules, debtors are assets. On our books after a sale, the value of the debtors has increased. The account must be debited. I'm applying my rules. Now, sales fits the definition of income. Our sales have increased. The rule says the account must be credited. So the account credited in the general ledger is sales. Why? Increase in income. Why was debtors control debited? An increase in the value of assets. The effect on the accounting equation, these posters were sold for 2,500 plus under assets because debtors value increased, a plus under owner's equity because income increases owner's equity. An increase in income is a plus under owner's equity. Liabilities, there is no effect. Now, this is not the whole story. That is part A of a sale. Record the sale. But when we make a sale, there is always a second part to the transaction. Because what happened here was, and let me clean this up quickly, a sale was made, stock was sold for 2,500, but the stock has been delivered and it has left the offices of Calibu Education. So we don't have the same amount of stock on hand anymore. We now have less stock. So I've written 4A. Transaction number 4, 4A. Record the sale. Debit debtors control or accounts receivable. Credit sales. Now there's a second part. There's a cost of the sale. Now at this point in time, we go and some textbooks will say expense the trading inventory, right? Trading inventory was an asset, but when you sell it, you're bringing in the expense of the sale, the cost of the sale. We didn't just sell these posters for 2,500. There was a cost. What was the cost? 1,250. That was the cost of the sale. Now, cost of sales is an expense, and the rule says an increase in expense, the account must get debited. The account that is debited is known as cost of sales. And why was it debited? Because there's an increase in expense. So at the date of the sale, the trading inventory is expensed. We open up an account called cost of sales. Cost of sales is debited with 1,250. Now, the value of our stock, we do not have the stock on hand anymore. We need to show stock is an asset. But the value of our asset has decreased because the stock was delivered to the school. So it's a decrease in assets, and the rule says credit the account if it's a decrease in assets. So the account is credited. Trading inventory is credited. Why? Decrease in the value of the asset. Now, what is the effect on the accounting equation? And listen carefully to this. Let me clean it up. What affects owner's equity? DICE, right? DICE. Now, just coincidentally, cost of sales is an expense. That E stands for expense. What does an expense do? An increase in expense results in a negative, a decrease in what the owner is worth. That is why, under owner's equity, it is minus the cost of the stock that was sold, 1,250, minus 1,250. And what happened to the value of the inventory that we have on hand? The inventory left the building. It's been delivered. Stock has decreased by 1,250, minus 1,250. And there's now no effect under liabilities for the sale and for the cost of the sale. And let me show you something quickly. We are using a perpetual inventory system which keeps an update of stock after every single transaction. After this transaction, I can determine the markup in currency value, or we can call it the gross profit of this one sale is 2,500 selling price minus the 1,250. From this sale, a gross profit of 1,250 was made. But more about that a little bit later. The important thing on this slide, you must know how to record in this table a sale of stock. And it has two parts. Part A, record the sale. Part B, record the cost of the sale. Two parts. The two accounts involved in the first one, this was a credit sale, debtors control and sales. The second part, debit cost of sales, increase in expense. Credit trading inventory, decrease in the value of the asset. And there's the effect on the accounting equation. Important transaction, a sale of stock, because there are two parts to it. But as you practice, I've said it and you know it, you will get better and better. This is worth a lot of marks. There's lots of information here. Okay, you need to know all these transactions, but this one has two parts to it. It's very important. Know how to record the sale of stock. Part A, record the sale. Part B, record the cost of the sale. Number 5. Paid broken society insurance, €1,000 cash to insure the office building from a break-in. Break-ins are occurring, and the business Calibre Education needs insurance to cover losses from a break-in. Now, how do we record this transaction? This payment was made by cheque. So the cheque was written out to Broken Society Insurance, that's the name of the insurance company. The sum of 1,000 Rand. Okay, I'm working in euros. 1,000 euros, there's the amount. The bookkeeper has signed this. It's check number 2. That is the sort code or branch code of the bank. And there's the branch code again. Check number 2. Right, so this check is written out. The check is issued to the Broken Society Insurance Company, and what remains is the check counterfoil or check stub. This check stub is used to record the transaction. So the transaction, we have read the transaction. We're going to identify the accounts involved. The first account is insurance, and this was paid by check, so it affects the business bank account. We need to classify these accounts. Insurance is an expense, and bank is an asset. Which document was used? Check counterfoil. Where is this recorded? In which journal? The cash book payments. We paid for insurance, which is the account that is debited. And the reason is, according to our accounting rules, when the account is debited, when an expense increases, the account is debited. So there's our reason why insurance was debited. Increase in expense. What happened to bank, which we identified as an asset? Because it has a positive, we will assume bank had a positive bank balance. So if the value of the bank account, which is an asset, decreases, the account in our books is credited. So account credit is bank. Reason? Decrease in the asset value. And the effect on the accounting equation, minus 1,000 under assets. An increase in expense results in minus 1,000 under owner's equity, and there's no liabilities involved. And the left-hand side is equal to the right-hand side. Remember, I'm going to summarize all these transactions on the table at the end of this video. But there now we've dealt with paid for insurance to Broken Society Insurance, 1,000 cash, wrote out a check. Next one. Richard, the owner, withdrew petty cash of 500 to pay for Caleb's computer lessons. So this is a personal transaction. The owner has taken money from the petty cash, 500. Remember, petty cash, an amount of money kept on the premises, cash, to make small payments, coffee, tea, etc., or to pay for the owner's son's computer lessons. So let's have a look how we record this, what document it is recorded on. So the bookkeeper or someone who's in charge of the petty cash, Marushka, my wife, she fills in a petty cash voucher. Reason for the 500 being withdrawn by the owner, he quickly needs to pay for the computer lessons. Remember, the owner's transactions and the business transactions are recorded separately, but this is a business transaction. It is drawings by the owner. The 500 Rand paid for the computer lessons will be recorded by the computer teacher, and we'll get a receipt for his proof of payment. But what's happened here in the business? The owner took 500 Rand for personal reasons. This gets recorded on the petty cash voucher, and according to the books of the business, the owner will be worth less by 500 because of the drawings, and this needs to be recorded. You can't just take money and spend it, because everything needs to be recorded, because the authorities are going to check your books. So the transaction will look like this. The owner withdrew 500 petty cash to pay for personal use. Read the transaction, identify the accounts involved, classify the accounts, apply the rules. By now, that is just second nature. Which document was recorded? The petty cash voucher was used to record this transaction. These types of transactions are recorded, and this here is actually recorded in the petty cash journal drawings, and the account that is debited is drawings. What the owner takes out of the business is known as drawings. And if I look at that rule, drawings has its own category. An increase in drawings, the rule says you must debit the general ledger account drawings. And there's the reason. Now, what happened to the petty cash, the other account? Petty cash, cash is an asset, a current asset. What has happened is the petty cash has decreased by 500. A decrease in assets, the account must get credited. So the account credited is petty cash. Decrease in the value of assets. And what is the effect number-wise on the accounting equation? Minus 500, because petty cash is an asset and it decreased by 500. Now, what is drawings? Drawings decreases owner's equity. That's why there's a minus 500. An increase in drawings decreases owner's equity, and there's no effect under liabilities. So there we go. There's another transaction that has been completed. The owner took petty cash for his own personal use, and there's the effect on the accounting equation. And I'll just quickly neaten it up. You can have a better look at the answer. The fight between the dikop and the chameleon for the honey from the bees and the milk from the cows intensified. The chameleon wanted the milk and the honey, but so did the dikop. So there was a lot of conflict and confrontation in the front yard. Meanwhile, in the backyard, business carried on at Caribou Education. The bookkeeper paid the computer store the amount outstanding for the computer. If we look back at number 3, a computer was purchased on credit from the computer store, 12,000. Credit, buy now, pay later. But later on in the month, Caribou Education paid the computer store for the computer, which had been bought on account. As you know, every single transaction needs to be documented. The computer store was paid, and should say the computer store was paid, and the amount of the computer was actually 12,000 Rand. So this year, this check needs to be written out again, as an error was made. And by the way, every time you write out a check costs money. So it's quite important. Maybe it's a good thing this came up. Don't make mistakes on the checks that are being either printed or written out. But remember, I said most payments now are being made electronically, but the textbooks still use quite often a checkbook to make cash payments. So the check counterfoil is left behind. This should be check number 3, and the transaction was documented, and now it needs to be recorded on the table. So it says here, paid the computer store for the amount outstanding on the computer. Read the transaction. Identify the accounts. The accounts involved is we are paying our creditors, the computer store, the money is coming out of our bank account, check is accepted as a cash payment, it affects our bank account. When the person receiving the check goes and deposits the check. So we need to classify the accounts that we now have identified. Remember, individually, this creditor or accounts payable would be the computer store. Now, why was creditors control debited and bank credited? Creditors control accounts payable is a liability. Bank with a positive bank balance is an asset. What has happened to the liability and what has happened to the asset? We owe less. A decrease in liabilities results in the general ledger account being debited. Creditors control is debited. The rule says decrease in liabilities, debit. What has happened to our bank balance when the payment was made? Minus. The value of the bank balance has decreased. The account needs to be credited. Right, we are applying our rules all the time. The important thing with every single transaction is we need to classify the accounts. Then we need to apply the rules according to what's happened with the accounts. And the effect on the accounting equation. The bank balance decreased by 12,000. And liabilities, we owe less by 12,000. Under owner's equity, there is no effect. So there we have it. There's the 7th transaction, paid a creditor, the computer store, the amount that we owed them for the purchase of the computer. There's the solution. That takes us to the last transaction in this lesson. Number 8. Receive the bank statement from the bank. That's where we have a bank account. The name of the bank is the bank. And on the bank statement there were bank charges of 200. And there was still fighting going on between the Dikop and the chameleon. Their mouths were watering at the thought of milk and honey from the cows and the bees. But who was going to get the milk and honey? Was it the Dikop or was it the chameleon? We will see. The bank statement arrived, and this is what we were made aware of. Service fees, which the bank charged us, charged Calibu Education. And this is a summary of all the transactions for the month of January. It's just an example of a statement. So there aren't too many transactions listed here. But the transaction says we still need to record the service fees, which falls under bank charges of 200. And we're notified of this by the bank at the end of the month when we receive our bank statement. We need to record the bank charges in this table. So it was number 8. The document we used to record the transaction, we received a bank statement from the bank. This is resulting in our bank balance decreasing the bank charges, and any transaction that results in our bank balance decreasing goes through our cash book payments. So we read the transactions, we're identifying the accounts. One account is bank charges and the other account is bank. Classify the accounts by definition. Bank charges by definition is an expense, and if the expense to our business increases, the rule says we must debit that account. So in the general ledger, the account that is debited is bank charges, and the reason, increase in expense. The account that is credited is our bank account. Bank is an asset, and our bank balance has decreased, so the rule says we must credit the bank account, and the reason, decrease in the value of the asset bank. The effect on the accounting equation, our bank balance decreased, so it's minus 200 underneath assets, and bank charges is an expense, and an increase indicated by this arrow going upwards. An increase in expense results in a decrease in what the owner is worth, and there's no effect under liabilities. And the left hand side of the equation is equal to the right hand side, because there was minus 200 on the left hand side and minus 200 on the right hand side. So this was the 8th transaction in this lesson, bank charges. And now what I'm going to do is I'm going to put all the transactions together on one table. This is a summary of all the 8 transactions that we completed in this lesson. I've put them all together. What I'm particularly interested in is the effect, the net effect on the accounting equation. So what I've done in the next slide is I've taken a screenshot of the transactions, only the numbers under the accounting equation, and we're going to just take a look at the net effect, the final effect of these 8 transactions. So I've taken a screenshot of this section that I'm putting a cross over, and we're going to, shall we say, start with a little bit of analysis and interpretation and see what has happened after these 8 transactions have taken place. And if you want, you can work through all the accounts that were debited and credited, but we did that one at a time. So let's have a look at the final numbers. These are the numbers from the previous slide, and if I add up all the transactions under assets, and I've put this calculator here just as an example. This has come off my laptop. You can use a basic calculator. You don't need a scientific calculator. You need a basic calculator because all you're doing is you're adding and subtracting here. And if the assets are added up and subtracted, 250,000 plus 7,300 minus 7,300 plus 12,000 plus 2,500 minus 125, etc. The assets will equal 249,550. Now if I go and add up owner's equity, you will see the answer is 249,550, which means assets equals owner's equity. And in this example, this whole lesson, well, not exactly, because there was a purchase of a computer on credit. There it is. And then the liability, the amount owing on the computer was paid, which resulted in 0 under liabilities. It was plus 12,000, increase in liabilities because a supplier was owed money, the computer store, and then later on in the month, the computer store was paid by check. Plus 12,000 minus 12,000 equals 0. But in this accounting equation, assets equals owner's equity plus liabilities, the left-hand side is equal to the right-hand side. And I've got here underneath owner's equity, the acronym I like to use. There are 4 things that affect owner's equity: drawings, income, capital, and expenses. And I'll just put a dice there, maybe you'll remember. Under owner's equity, you've got dice. Okay, so after we've recorded all these transactions, the left-hand side is still equal to the right-hand side. We can also calculate here the profit. Now this is only after a few transactions, but profit is equal to income minus expenses. And if I take the income from the sales, I subtract cost of sales. I'm not sure what that expense was. Insurance, I remember now, 500 was taken out of petty cash, and 200 was for bank charges. This year the 500 was drawings, which affects owner's equity. And if I said income 2,500 minus cost of sales 1,250 minus 1,000 for insurance minus 500 for drawings minus 200 for bank charges, we will get either a profit or a loss just looking at these transactions. Okay, the business has hardly been going, so only a few transactions, but the point here is, I'm just stressing again, how to calculate profit. It's income minus expenses. Assets is not involved in calculating the profit. Sure, I'm making a mistake because income minus expenses is equal to the profit or loss. Drawings should not be included in the calculation of the profit. It's easy to make a mistake, especially when there are a lot of numbers flying around. That's why you need to know how to calculate profit. You need to know how to categorize what is income and what is an expense, because profit is equal to income minus expenses. I nearly included drawings, but luckily I do know the formula to calculate profit. And when you do the math there, 2,500 minus 1,250 minus 1,000 minus 200, the answer is equal to 50. So at the moment there's a profit of 50. Now, what is the owner worth? And there are two ways to calculate what the owner is worth. I've done this in previous videos, but I want to show it to you again. The owner is worth 249,550. And how did I calculate that? Under owner's equity, I added and subtracted everything that was under owner's equity. We're calculating what the owner is worth according to the books of Calibu Education. And I used this dice. Drawings, income, capital, and expenses. Drawings will decrease what the owner is worth. Income will increase what the owner is worth. Capital will increase according to the books what the owner is worth. And an expense will decrease what the owner is worth. So there's one way of calculating owner's equity, by adding and subtracting these four components of owner's equity. The other way, if you're given this information, to calculate owner's equity, and I have done this before, but let's have a look here. Assets equals owner's equity plus liabilities. That is my accounting equation. The question was, calculate owner's equity. What is the owner worth? If I take liabilities to the other side of the equal sign, according to maths law, that plus becomes a minus. Then I will have assets minus liabilities is equal to owner's equity. Now I can calculate owner's equity in a different way. Owner's equity is the total value of the assets minus liabilities. Assets, 249,550. Liabilities just so happen to be 0 after these transactions had taken place. And what is owner's equity equal to? 249,550 minus 0 is equal to 249,550. So there were two ways to calculate owner's equity. Use the DICE acronym, or owner's equity is equal to assets minus liabilities. So after all those transactions, we could calculate the profit after those 8 transactions. We checked out the effect of each one on the accounting equation. We looked at the source documents that were used. We looked at which account was debited, which account was credited, why those accounts were debited and credited. We used the accounting rules. So there was quite a bit in this lesson. I hope you learned plenty, but let's see what's happening let's see what's going on in the front yard with the chameleon and the dikop. The angel was saddened as the cow that was going to provide milk left the front yard in search of some peaceful place to graze. The bees moved on also to live in a peaceful environment where there was no conflict and fighting, rather no fighting. The dikop, the aggressive dikop, fought with the chameleon, and as a result of their ongoing conflict and fighting, they lost out on milk and honey as the bees and the cows moved on to a peaceful place to live. So if the dikop and the chameleon had learnt to share and the skill of negotiating, they both would have been better off. As the cow and the bees, they were looking for a place of stability, which was not provided in the front yard. Caribou education in the backyard, despite of what was going on in the front yard, maintained their focus and their goal to complete this video, and in doing so the video was completed. And when the milk and honey comes in to Caribou education, the lesson learnt is to share the milk and honey. Share the milk and honey, and also stay focused despite on what's going on around you. I hope you enjoyed this video, this lesson, a little bit different, but I hope you got the accounting knowledge and you enjoyed the little bit of entertainment, the story. Cheers. Thank you everyone for watching. I hope you enjoyed that little video.